Hi, everyone, and thank you for joining us for today's session with a very key individual involved with economy and economists reporting, analyzing what's going on in our markets with NAR. We have Nadia here with us, Nadia Evangelo. I'm going to tell you a little bit about Nadia, and then we're literally going to turn it over to her since we've got precious time to hear all her reporting. Nadia is a principal economist and director of real estate at the National Association of Realtors, where she leads national and local market intelligence across, I can't see all my words, across residential and commercial real estate sectors. She specializes in identifying emerging trends across local markets and translating complex economic developments into actionable insights for realtors nationwide. Her work focuses on housing affordability, demographic and migration shifts. Sorry, I got to push a button here to let some more people in the room. And the evolving supply-demand dynamics shaping the U.S. real estate markets. She also conducts analysis on federal, sorry guys, I'm literally in the, oh my gosh.
I'm
All
letting
right.
people in. Don't worry about it.
Okay, confession. I'm sitting in the lounge waiting to board a plane, and life is crazy. Okay, so she also conducts analysis on federal, state, and local policy issues and evaluates how legislative and regulatory changes may affect real estate markets and home ownership. Her analysis is regularly featured in major media outlets where she provides commentary on real estate market conditions and housing supply. So just wanted to give you a quick update on why Nadia is here as opposed to Lawrence Yoon. He kindly accepted before he realized he was overcommitted. And thank goodness he made he extended the invitation to Nadia, who was equally qualified to do this presentation for us. So Nadia, with that said, I'm going to hide myself and get ready for my plane, and I'll keep listening in. Thank you so much.
Thank you, Marcia, and good afternoon, everyone. It's a pleasure to speak with such a global audience like today. So over the next 30 minutes, I would like to walk you through three key things. So first of all, the current state of the U.S. economy, where growth, inflation, and the labor market stand today. Second, the state of the U.S. market, housing market, which continues to be one of the most important sectors of the economy. And third, what we see coming next. So including investment trends and global capital flows into the United States. So the U.S. housing market often reflects broader economic conditions. So understanding housing also tells us a lot about consumer confidence, investment trends, and long-term economic growth. So let's start first with the broader economy. I will start sharing my screen. Just bear with me 1 minute. So one of the biggest developments in the past year has been the monetary policy. So in 2025, the Federal Reserve cut interest rates 3 times. So we had a cut in September, October, and December. And the timing here really matters. So this was not a panic Federal Reserve. This was not an emergency response. This was a cautious central bank that we saw. So they moved slowly, intentionally, because inflation had cooled, but the economy was still growing. So now the big question that we hear and I get everywhere I go is, will the Fed continue cutting rates in 2026? And my answer is yes, but again, gradually. Why? Because job growth is slowing down. We have the figures today. Unfortunately, we had job losses in February, so I will refer to that a little later. And what this means, slower job creation reduces usually the inflation pressure, which gives the Federal Reserve room to ease borrowing costs without risking a resurgence in prices. So think of 2025 as a turning point, and now 2026 we're going to have a couple of rate cuts, but mostly in the second half of the year. So this is what we are seeing for from what the actions from the Federal Reserve in 2026. So now when the Federal Reserve cuts rates, the financial markets react. And that's exactly what we saw. So let's talk now about the mortgage rate. So because this is where economics becomes like very, very real, very fast. So as of February 2026, the average 30-year fixed mortgage rate is around was 6.05%. So down from about like 6.85% a year ago. And in fact, last week, like mortgage rates fell below the 6%. So it was like 5.98%. According to yesterday's release from Freddie Mac, it was like 6. So it still like remained like at 6% like threshold. And I will say that this is a big psychological and financial like milestone, because this is the first time we have seen this rate since September of 2022. So that's a confidence, I will say, trigger for buyers, especially those who have been holding out for rates to start with the 5 again. Specifically, what we see is that when on a $400,000 dollars like home, today's like rates bring the payment down to about like 1,900. So that's a significant like improvement from a year ago, and puts about like $2,000 dollars like back into a buyer's pocket like annually when we take a look and we compare these figures with the rate that we had last year. So that may look modest, but in practice it's meaningful, and I can explain like why. So a 1 percentage point drop in mortgage rate increases purchasing power for buyers by about like 10%, and that's math. So for a buyer on the margin, that difference means qualifying versus not qualifying, like stretching versus like feeling comfortable, and waiting versus acting. Whoever like is on the margin, like that, they're like finally now with this 1 percentage point, they're able to qualify to. We see like more buyers back to the market. So nationally, when rates move from 7% that we had like roughly like last year to 6% currently, what we see is that about 5.5 million more households can afford to purchase the median priced home. And roughly about 1.6 from those, about like 1.6 million renters. So these are the potential first-time buyers. And that's very important since like first-time buyer share has reached like the lowest like that we have seen like on record. So that means when rates move, behavior changes quickly as well. And another very important like signal is that the mortgage rate like spread has narrowed. That tell us like investors see less risk like in mortgage lending. And why is this is important? Because that helps mortgage rates to move lower even without a big drop in treasury yields. Also, it's an indicator that the mortgage market is slowly like moving like back to normal. So, however, due to the recent like geopolitical like tensions that we have and rising oil prices, mortgage rates will likely like rise, though it could be like for only a temporary like period. This is what we expect. We don't expect to have like higher inflation. We are going to have high inflation these days, like this week, since we have this turmoil over there. So, but our forecast for mortgage rates is to average about like 6% in 2026. And as we see, like we are very close to that. So this also means that in the next like months, we may see like later in the year to have like even like, and we have seen already like rates to drop like below the 6%. Another key pillar like of the U.S. economy is the labor market. So for several years following the pandemic, the labor market has extraordinarily like strong. So it was like very, very strong. So job creation was running well above like the historic like averages. However, over the past year, we have seen some moderation. We have seen some slowdown. One of the important like developments was the revision to the employment data. So the Bureau of Labor Statistics revised down like the number of jobs added in 2025. So originally, it appeared that we had about like 580,000 like jobs created in 2025, but after the revisions, we have less than 200,000 like jobs created, about like 181,000 like jobs during like 2025. So job growth is still positive. Unfortunately, the latest figures I didn't have the time to include it in my slide, but what we got today is that we had job losses in February compared to the previous month, and this is mostly driven from the ongoing federal the ongoing layoffs that we have in the federal sector. So we have seen unfortunately fewer job losses compared to January, and but I think that the good what we should do right now is to check the next readings and the employment situation, and to track that to see how a job market will perform. But we have this slowdown, we see it in the data. On the other hand, this slowdown helps the Federal Reserve to cut the rate. So this is, and still we think overall in the history, as you can tell from the graph, we have the number of people employed in the U.S. economy remains very high. We have about 150, more than 158 million workers as of February, January that I had the figures, but they're around there, and we have about 6 million more people working than pre-pandemic. So we still have very good employment. However, we see the slowdown, and of course, we're going to monitor in the next months the readings. Then, as we know, job creation is not the same everywhere, so across the country. So some states have experienced stronger expansion than others. So specifically in this map here, states with green color, as you see here in the first map on the left. States with a green color like Idaho, Utah, and Florida have seen some of the strongest employment growth since the pandemic. So we compare March of 2020 with now. So, and what we see is that these are the states with the strongest employment growth. Many of these areas benefited from migration flows, population growth, and strong construction activity. And then what we also have with the orange color, we have DC and Hawaii, that these are the two areas that they are still haven't recovered, their economies haven't recovered the jobs that were lost during the pandemic. So we have in DC, we have about 8% fewer jobs than we had pre-pandemic. So they haven't recovered this area specifically, the jobs during the pandemic. And again, we see Hawaii, but Hawaii is very close to make up all these jobs. So it's very close to have more than the pre-pandemic level. It's the DC that we see this slowdown mostly. Then now let's talk about inflation, because inflation has been the dominant economic story over the past few years. So at its peak, mid 2022, inflation in the United States reached about 9%, the highest level that we had about 4 decades. Since then, inflation has significantly decreased. So as of January that we had the latest figure, inflation was running at about 2.4%, which is very close to the Federal Reserve's long-term target. So from a macroeconomic perspective, that's a major improvement. So, however, not all components of the inflation are at that level. So one of the biggest contributors, I will say, to inflation today continues to be the housing costs, specifically shelter costs. So housing makes up a large share of the consumer price index, the CPI, and rent increases tend to adjust slowly. So shelter inflation is still running about 3%, so more than the overall inflation, pushing up still an inflation to these figures. So the good news is that this pressure is narrowing. So the challenge is that, and we see from the private sector data that rent growth is relatively flat year over year. So we expect that to be reflected in the federal and the government data as well sometime soon. We see this deceleration in the rent growth, but still they're still reporting 3%. However, what we see in the private sector is about 1%, less than 1%. So this further deceleration will be reflected in the following months, and will help with overall inflation to be below the 3% and below probably 2.5. Of course, everything changes depending on the geopolitical tensions that we have, but So far, this is what we see like from the data. Despite these challenges, so the U.S. economy continues to grow. So if we look at the GDP growth over the past like several years, we see that the economy has remained like resilient. So growth was exceptionally like strong during the pandemic recovery, especially like in 2021, but has since moderated to, I would say this is more sustainable like level. So in the fourth quarter of 2025, in the last quarter, we see that the economy grew about like 1.4%. This is a slowdown from the 4.4% that we had in the third quarter of 2025, but still this is a steady like growth. We see this growth, and have like a leave like in mind. I would like to remind you that economists like spent much of 2024, 2025 like predicting a soft landing. And what we have actually seen is a remarkable like resilient expansion. So why do we see that the economy is still growing? So first of all, it's consumer spending. So the consumer spending remains the backbone. So even as inflation edged up, households like continue to spend on travel, like dining, healthcare, and experiences. Of course, you have heard already like many times that we are in a K-shaped economy, and we see that reflected like in the data and the consumer spending. Indeed, we have wealthier like households that they continue to drive this consumers like spending like strong as compared to middle income like households that unfortunately they are on the sidelines. They have like financial hurdles. And we are like in a K-shaped economy that we also see that reflected, and I will talk about that in the housing market as well, with luxury market to outperform. So what we see, so despite all the pressures, what we see overall is that the U.S. economy continued to grow, not explosively, not dramatically, but steadily. We see 1.4% like growth. Now, when we look at the broader global picture, the U.S. economy also stands out in several like important ways. So one topic that often comes up in discussions is public debt. So the U.S. has experienced like a significant increase in government like debt over the past decade. I have included here in this slide. So for example, from 2020 to 2024, we have about like 20 trillion like added. So the fiscal policy, why? Because the fiscal policy has been like expansionary, like from the US, especially when we compare it with other like European like countries that they pursue like fiscal consolidation. So we have like different like policies that they followed, and we have with the US increasing like from about like 12 trillion the debt in just like 4 years. However, what here is something very interesting and surprising at the same time. So when we look beyond the government like debt and examine household balance sheets, we see a very different like story. After the financial crisis in 2008, US households significantly reduced their leverage. So relative to the GDP, the gross domestic product, American household debt has actually declined. So while in several other like developed economies that are included here in the slide, including like parts of Europe and Canada, for example, like private sector debt has remained relatively like elevated. So the picture is it changes when we take a look and we go at the individual like about the debt of the individuals. So government debt has increased, but household balance sheets are stronger than they were like before the financial crisis. And that strength is one of the reasons we see this US consumer like spending that has remained like resilient. So I think this metric can also explain what we expect as well, and to explain as well like what's really happening like, in the consumer spending and why it's still like strong despite like all these prices, that higher price that we have. So American households today are in stronger position than before the financial crisis. Home equity levels are high. We need to have that in mind. Loan to value like ratios as well are generally like healthy. And what we also, what else can explain that is like delinquency rates like remain low. This is what we see from the data. So most homeowners hold fixed rate like mortgages below like today's like rates. So this means that while affordability is challenging for new buyers, existing like homeowners are financially like, stable. So that distinction like is important. So the stress in this housing cycle is concentrated mostly about like buyers or like non-existing owners that we currently like have. So I just wanted to show you the leverage like paradox here as well, with most like the US households like leveraged. However, like in Europe and Canada, it's about like more than 100% the household debt compared to the GDP. However, like in the US, it's driving like down, and we see that it's like 71% like that we see, and significantly like less from Norway, for example, other like European countries. Then what I would like now to mention is like to turn a little like now to the housing market specifically. So which is one of the most important sectors like of the US economy. So over the past few years, we have experienced one of the most unusual housing cycles in the modern history. So we went from record low mortgage rates to the fastest like rate hikes in decades. And then we saw a surge in demand during the pandemic, followed by years of limited like supply and double-digit like price appreciation. And now what we have, like we are in an adjustment like phase. We have like inventories that are finally rising again. Prices have started to stabilize. We see about like 0.4% like year-over-year price increases. So now it should be the moment when the housing market finally like normalizes. And when we have a normal market, usually when we have like more homes available for sale, this can also mean to more home sales as well. But what we actually see is that we don't see that yet. We still see sluggish like activity in the housing market. And I would like to go through a little like in this graph that I have here, that you're able to see both the existing home sales and the inventory, which means like how many homes are available for sale since 1999. So what we see is like from 1999, for example, until 2005, so before the housing downturn, we see that these two factors were moving together. So something that we usually expect to happen in a healthy market. So more homes available for sale means like more option for the buyers, and make home sales then to increase since there are more options like for these buyers. Then, as you can see, after 2023, with the underproduction, the inventory was declining, but home sales activity was strong, was going like up. So it was increasing. So this is, I will say, this is when it started, this housing shortage that we are still like experiencing. So, but of course, how home sales continue to increase back then, because of strong affordability. And to give you some more context is that during 2009 until like, for example, until 2019, so before the pandemic, if we take out like the pandemic, we see that affordability was very strong. So specifically like the typical family was able to afford to buy a home about like 70% more than the median price. Or you can translate that over that the typical family was earning about 70% more than the income needed to purchase the median price home. And so this is, it shows how strong the affordability was, and how this, even though with less inventory, home sales were very strong because demand was very strong like during that time. So now we have the opposite. So what we see now is that we have more inventory coming out like from the lows that we had, historic lows, but now we have more inventory, but we don't see the pace like of the existing home sales to increase at the level that we will expect it, especially when we think about the pent-up demand that was existing like from the low inventory that we had like in the recent years. So what we see is that we don't see that to to react like the housing market. And the reason again here is affordability. And now is the opposite. So now we have this weak affordability that has kept like many people like out in the sidelines. It's not that they don't want to buy, demand is there, but affordability makes like many of them to be out of the market. And even though we see this improvement, I will explain like a little like later what another factor that can explain more this paradox that we have right now with no not home sales like to react to this like more inventory because they're like not so we have a shortage of affordable like inventory, and I will explain like later in my slides. But right now I wanted to show you what I saw really like about it, and I spoke about the economic like growth, and I refer to K-shaped like economy. So here you also see you see that we get a different story when we take a look at the market by price segment. And that brings us here. So while home sales in 2025 were virtually flat, and the past 2 years were the worst like year since the mid of 1990s, the luxury segment grew more than 10%. So specifically here we have the 2026 figures. What we as of January 2026, we have home sales overall that they dropped like about 8%. But when we take a look, we see that home sales year over year from for homes $1 million and up, we see that they're still like higher. We have about like 2% like more sales activity, home sales in that price category than a year ago. However, when we compare with the year-over-year sales activity for price for homes in the price range $100,000 to $250,000, we see that we have about like 9% like lower than a year ago. So what this tells us that, and this is what we also expect like to happen in the real estate market, is that because these higher income buyers are less affected by rising mortgage rates or the higher rate that we have, but because they often pay all cash, or they are able to get like a smaller loan as well. So this is something that we expect to see, like that they're like high earners, high income like buyers are there. It's like the middle income like buyers that they're on the sidelines and they have like difficulty in finding like a home that can match like the price like range that they're looking for. Then the good news is that housing affordability has started to improve. We see this improvement. So at the peak of affordability crisis, like in October 2023, a household needed about 28% of its income to make a mortgage payment on a typical home. And what we want to have is 25% the maximum, because we have about like 5%, because 25 is about the mortgage payment, how much like the mortgage payment takes like from the gross income. So we leave about like 5% for property taxes, HOA fees, and other like insurance, home insurance. So what we want to have is the monthly mortgage payment not to exceed the 25%. And today that share has declined to about 21.5%. So that improvement, and that's the best like level we had like since March of 2022. And that improvement reflects a combination like of factors. So first of all, we have mortgage rates that they have come down. They're like close to 6%. Home price growth has slowed down. They're still like increasing. We see like price appreciation, but it's like slower. It's about like 0.4% like year over year. And what we see is that incomes have continued like they continue to rise. And what we see is that this rise in like incomes in combination with the mortgage rates, the lower mortgage rates can offset these price gains that we still have, and can bring like affordability at these lower levels that we have. And this is very encouraging, this improving like conditions like for many households, and especially for first-time buyers that still feels like significant like barriers. So this brings me now a little bit why I believe that to what I believe is the central like challenge of today's like housing market. So the issue is not simply that there are too few like homes overall. So we have a housing shortage, we know that, but we see some improvement. So the real challenge is that the homes available in the market are not aligned with what households can afford to buy. So what we actually did is we measure this using what we call the income-based like housing supply gap. So in simple terms, what this tells us is that we compare two things. So the price of homes currently listed on the market and the price that households at different income levels can afford to buy. So what we can find here, what we see is that the shortage is most severe like in the lower and middle income price ranges. And this is exactly like where the first-time buyers like are. So the challenge is not just building like more homes; it's building housing at price points like that align with households' incomes. Then here I included also our forecast. We expect, due to these lower rates that we have mortgage rates and with more inventory to align, because we see an improvement in aligning like the inventory with the prices, the price points that people can afford to buy. We expect home sales activity to increase about like 14% in 2026, and mortgages, as I mentioned, like to be around like 6%. I can go over. I have some hot spots here. I know that I ran out of time, but I included in my slides some more.
I think this is important. So hopefully a few of us, my plane was delayed, by the way, so I'm back, but which is a blessing. So those of us who can stay on, I think they'd appreciate if you want to go a couple minutes over, and then anybody has a burning question or comment, you can just raise the hand icon, and hopefully Shirley or I will see it. We can give you a chance to speak if you'd like.
Perfect.
Oh, yes, and yes, she is going to share the presentation, and it's being recorded, so all good.
And then, so I included here in my slides. Yes, I will share all these slides. So some of the hotspots that we were able to identify, like some of the markets that we expect to outperform. So as I mentioned, like we expect like home sales activity to increase about 14% in these areas, even more. These areas, they have like a larger like improvement in the alignment of inventory with what people can afford to buy, really afford there. So that's the reason with this lower rates, we expect like more buyers to be back. And since there are like more homes available for sale at price points that they can afford to buy, this will translate to real like home sales activity. Then I also included here a little bit like about the FDIs, foreign direct investments. We see that the US remains the number one, even though like what we had like in the trend. So we are the top with 279 like billion, and then Singapore like to follow with 143. What we also see, and what I would like to mention, is that how the FDIs in the US real estate has expanded. So we have about the real estate FDI like grew nearly about twice the pace of the overall US foreign investment. And how many like we have in the last like decade, we have the real estate FDIs have increased about like 120 billion. I also have some about the residential market have included here from our report. So the top, for example, foreign like buyers by volume and share, we see that China, Canada, Mexico are the top three countries like buying residential properties in the US as of 2025, and what are the top destinations for international like, capital. So we have like Florida, California, Texas, New York, and Arizona are these the destinations for most of these foreign like buyers. And some of the characteristics between like foreign buyers and the US overall like home buyers, we see that they tend to buy like more expensive like properties. They tend to about like 47% of the foreign buyers pay all cash, and they use it like about like 50% of them they use it like for vacation rental like properties. And some of the property type like detached how many, like 77%. So I included that about like information about what kind of properties as well they buy. So in a nutshell, this is I wanted like to present to you, and I'm happy to take any questions if you have.
This was wonderful. So I do wonder, because I personally experienced this where we had a European investor coming into a project, and with what's happened here in the United States, they backed out and they said, no, thank you, nothing, no longer interested in the United States. So just wondering if you're starting to hear much of that, or if I'm a one-off, in that
Yeah,
case.
I I don't hear it from our members. We see some of them moving here to make like some business here, but the data is not there yet. Like 2025 will be like about FDIs, about investments will be like later, like in the summer. So
Yeah.
I think this is going to be very interesting. Like look there, we are looking forward actually to take a look there, but. And how like exports imports have impacted like at state level, because this is what we also see like for tariffs, for example. We see that the trade, like every state is relying like in a different like level with the trade. So for example, Louisiana is significant like a significant like share of the GDP is impacted like from the trade. So this is also what we are monitoring, but still we don't have like the figures for 2025, unfortunately. But yeah, we are gonna, but I don't hear it yet from our members.
Interesting. Anyone else would like to unmute? Because we've got a few precious moments here. If any comments or observations that you'd like to share, please do so. We're so fortunate to have Nadia here with us today. This is one of our member benefits as NAR members. We can reach out. There's a lot of research that's available to us at no cost. And to be able to get to people of your level, and your esteem to present for us is very appreciated. Absolutely. Let's see. I'm seeing in the comments, thank you. Wonderful, informative seminar, wonderful presentation, so much good information. So, and the question of the day, which we know, are we sharing this presentation? Absolutely. Was that your QR code on the last slide?
Yes, yes,
You
sorry,
want to bring
yes,
that up again real quick? I don't think everybody got a chance to snap that.
of
Can
course.
you
And
do
while
that?
you're bringing that up, Nadia, thank you very much for this presentation.
Oh,
Do you have any information on Americans moving abroad, selling property and moving abroad? Do you capture that data?
unfortunately, we don't capture that. So but what we see is that from the data, like from the census data, as far as like moving here, so the net migration, international migration has slowed down significantly. I think you may have heard that. So we see this that, and we expected to see that like the international like migration too, but coming in the US to slow down. But we don't capture like from here to where
Okay.
from our survey.
Okay, with just shy of 10 minutes over, I think we can, first of all, again, thank you so much for stepping in. You are not a replacement for Dr.
Oh,
Yuen. You are
thank you.
a compliment for us
Oh,
from Dr. Yuen. So appreciate you.
thank you
Thank
so
you
much.
so much. And be well, my friends. See some of you, most of you, in the coming week in Cannes. Very excited about that.
Have a
And
safe flight, everybody.
yeah, we're very global, this group. So we so appreciate all your information, was very helpful. So thanks again. Bye, everybody.
Thank
Thank
you.
Take
you.
Bye.
care. Bye.